Hi everyone, it's Steve Giles again and welcome to video 4 in our series about the 6 building blocks to financial success. In this video we're going to talk about investing wisely and tax effectively. So the previous 2 videos we talked about freeing up your cash flow, having surplus income each month that you can use to invest, and we also talked about freeing up some of the equity that you may have in a property or tapping into those savings that you have and really making sure that we are investing wisely and tax effectively. So now we'll talk about the sort of investments that you can look at putting your money into, because essentially what you're doing now is you're borrowing money at say 4% or thereabouts, and we want to make sure that when we're investing we're getting a rate of return greater than that. So there's different assets such as, which are broken into growth and defensive assets. So a defensive asset is an asset such as cash, fixed interest or bonds, which essentially just paying you a rate of interest with very little or no capital fluctuation. Then there's assets such as growth assets, which are your shares and property. They're the more traditional ones that we talk about. They're assets that do fluctuate over the short term, but we do believe in the long term will be able to provide greater capital return. The other asset that we do talk about as well is your business. So if you have a business or you're looking to start a business, you can borrow money relatively cheaply to invest in that business. I myself, for instance, believe that if I borrow money at 4%, I'll be able to get a greater rate of return from that. So if you own a business and you think that you can buy a machine for your business that'll be able to help you grow, and you can borrow the money very cheaply, say 4, 5 or 6%, it probably makes sense for some of us to do that. Similarly, taking on an employee or buying out another already established business or expanding into new areas, they're again ways that we can grow our own business and using that equity and that cash flow to fund that. So what I'll talk to you now is about during the traditional methods, which is direct share portfolio and also property. So if we look at a share portfolio, shares over the long term, if we just focused on a aggressive portfolio where we're just going 100% into shares, we might look at getting a rate of return over long term of around about 8.5%, and that's the growth rate. We're not really relying on any dividends in that return, and 8.5% is therefore hopefully a better return than the cost of the borrowing, 4%, and so that's a pretty good rate of return. Also, we can look at investing in property. Now, property may give you a similar sort of rate of return. Over the long term, we might say again 8.5%, but that rate of return is going to look very different. We're going to say that it's probably 5% growth, and that you may have it rented out, and that might give you a 3.5% rental yield or income yield on that property. So we want to be investing long term in those sort of growth assets that are going to be giving us these sorts of rate of returns instead of cash and fixed interest, which generally give a lower rate of return. So it's about identifying if that is something more suitable for you. So the previous videos we talked about freeing up roughly about 160,000 in cash to be able to invest. Property is not necessarily going to get you very far with 160,000, so we may be, if we go down this path, we may be taking on additional debt. There's obviously additional risks about that, which we'll talk about in the next video, but 160,000 will certainly buy you a pretty well diversified and high quality share portfolio, so that may be something that you're more comfortable with. Again, it's about finding out what you're most comfortable investing in. Similarly, if it's your business, 160,000 plus, the freeing up of 550 a month in cash flow will go quite far in building up your business or starting a business. So again, if we're going to look at investing in these things or investing in our business, we want to make sure that we're doing it in the most tax effective manner. So there's a number of things that we want to talk about in that. So having it in the right structure, for instance, if you're going to be investing in a share portfolio, are you going to be doing it in your name, in your partner's name, or are you going to be doing it in a family trust, in a company, or superannuation fund? There's a whole bunch of different ways you can invest, and there's different tax treatments for each of those things. Similarly, there's the benefits in property are depreciation. If you're buying a property, you can depreciate that asset over a period of time, and so that can give some fairly significant tax advantages. We also want to talk about franking credits. So if you've got franked dividends coming through from those shares which is essentially the company's paid the company tax rate, it's passing it through to you. If you have that in a pension account or superannuation, you're going to be able to get some tax credits back from that. So again, that's a little bit more tax effective for you. Similarly, if you're borrowing the $160,000 and maybe even taking an additional loan to buy a better property, you've got the tax deductibility of the interest. So you're borrowing money to invest. That means that interest is generally going to be tax deductible. So we want to make sure that you're doing that properly. So hopefully this is all helping, and that we're now kind of building up an idea of freeing up some cash flow, freeing up some assets, and then we're going to start investing that, and where we're going to invest that and making sure that's tax effective. In the next video we're going to talk about the risk management side of it, because as I've touched on, there are a number of risks associated with these sorts of strategies. So we'll see you in the next video, but as always, please like us on Facebook, please check out our YouTube channel and also our website, and please mention this video to friends and family who you think should be seeing this sort of content. Again, so thanks very much for watching, and we'll see you again soon. Thanks.